Hey guys, welcome back to Beyond Income. Imagine this. You wake up one morning, check your phone, and see that the price of oil has just spiked past $120 a barrel again. Your gas tank that used to cost $60 to fill now costs $85. Grocery prices are climbing. Your heating bill is about to jump. And if you have any investments or retirement savings, they're probably taking a hit too. This isn't some future prediction. This is happening right now in 2026 because of the escalating situation with Iran. The war in the Middle East has turned the global energy market upside down. And here's the scary part. Most people are just watching it happen, feeling helpless. But today, I'm not here to scare you. I'm here to show you exactly what's going on, why it matters to your wallet, and most importantly, what smart moves you can make in 2026 to protect and even grow your money during this chaos. If you're in the US or UK and you're worried about rising fuel prices, inflation coming back, and your savings losing power, stick with me till the end, because by the time this video finishes, you'll have a clear game plan. Let's dive in. Look, I know oil prices going crazy isn't new. We saw it during Russia-Ukraine, we saw it in 2022, but this time feels different. Why? Because the Strait of Hormuz, the narrow waterway through which almost 20% of the world's oil passes every single day, has been heavily disrupted. Iran has effectively made shipping there extremely risky. Tankers are being attacked, insurance costs have skyrocketed, and many companies have simply stopped sailing through that route. On top of that, there have been direct strikes on energy infrastructure in the region. Refineries, storage facilities, even some LNG plants have been hit. The result? Supply has taken a massive hit while the world still needs the same amount of oil. That's Economics 101. When supply drops suddenly and demand stays high, prices shoot up. And that's exactly what we've seen. Brent crude, which is the global benchmark, went from around $70 to $75 before the conflict started in late February, all the way up to $119 to $20 at its peak. Even now, after some pullback due to ceasefire talks, it's hovering in the $100 to $106 range and remains extremely volatile. Let me tell you what this really means for normal people like you and me. First, gasoline and diesel prices. In the US, average gas prices have already jumped to nearly $4 per gallon in many places. That's up more than 30 to 34% since the war began. In the UK, petrol is climbing fast. If you drive to work every day or have a long commute, this is directly eating into your monthly budget. Second, inflation is waking up again. Energy is the backbone of everything. Transportation, manufacturing, food production, plastics. When oil goes up, almost everything else follows. Central banks like the Federal Reserve and the Bank of England were hoping to cut interest rates this year, but this oil shock is making them nervous. Rate cuts might get delayed, which means mortgages and loans stay expensive for longer. Third, your investments. If you have money in the stock market, you've probably noticed the volatility. Tech stocks and growth companies get hit hard when energy costs rise because companies' profits get squeezed. On the other hand, energy companies and certain value stocks have been doing better. So the big question is, what should you actually do about it? Let's talk practical steps. No fluff, just real, actionable advice for 2026. 1. Protect your day-to-day budget. Review your monthly expenses right now. Cut unnecessary spending for the next 3 to 6 months. If possible, look for a more fuel-efficient car or consider carpooling or public transport where it makes sense. Lock in fixed-rate energy contracts if you're in the UK, if still available, before prices climb further. 2. Inflation-proof your savings. High inflation plus high oil is your cash in the bank is losing purchasing power fast. Here's what smart people are doing. Move some money into high-yield savings accounts or short-term treasuries that pay better interest. Consider I-bonds or inflation-linked bonds if available in your country. Gold and silver often perform well during geopolitical crises and energy shocks. Many investors are adding 5 to 10% allocation to gold ETFs or physical gold as a hedge. 3. Smart investing during energy crisis. This is where opportunity lies. Energy sector plays. Oil and gas companies, especially big, stable ones like Exxon, Chevron, Shell, and BP, have been seeing higher profits when oil stays above $90 to $100. But be careful, don't go all in. The prices are volatile. If ceasefire talks progress fast, oil could drop sharply again. Defensive stocks. Utilities, consumer staples, and healthcare tend to hold up better when the economy gets shaky. Diversification is key. Don't put everything in one basket. A simple portfolio mix could be 40 to 50% broad stock market, S&P 500 or global ETFs, 15 to 20% energy or commodities, 10 to 15% gold or real assets, the rest in bonds or cash equivalents. If you're a beginner, low-cost index funds or ETFs are still your best friend. Don't try to time the market perfectly. Nobody can. 4. Long-term passive income ideas that work even now. Even in this environment, you can build income that fights inflation. Dividend-paying energy or utility stocks. REITs focused on infrastructure or warehouses. They often pass on higher costs. Starting or scaling a side hustle that isn't heavily dependent on fuel costs, online businesses, digital products, etc. The key mindset shift. Stop thinking only about making more money and start thinking about protecting the value of the money you already have. Now, let's be honest for a second. Nobody knows exactly how long this conflict will last. Ceasefire talks are happening, Trump has delayed some strikes, and there's guarded hope. But even oil executives at big conferences are saying the full impact isn't priced in yet. Physical supply disruptions through the Strait of Hormuz could take months to fully resolve. So my advice is simple. Prepare for higher energy prices and higher inflation to stick around at least through mid to late 2026. Hope for the best, but plan for the worst. If the situation de-escalates quickly, great, your hedges will still protect you in the future. If it drags on, you'll be glad you took action now. Before I wrap up, here's one more thing I want you to remember. Crises like this create fear, but they also create opportunities for those who stay calm and think long-term. The people who panic sell at the bottom or do nothing usually regret it later. The ones who make small, smart adjustments now come out stronger. If you found this helpful, do me a favor, hit that like button and subscribe to Beyond Income. I'm making more videos like this every week to help regular people build and protect their money in uncertain times. Drop a comment below and tell me, are you feeling the impact of higher gas prices yet? What's one thing you're planning to do differently with your money in 2026? I read every comment and try to reply when I can. Thanks so much for watching till the end. Stay safe, stay smart with your money, and I'll see you in the next video. Take care.